Now, welcome to Biztech's Asian Midday Market Watch. Our guest today is David Cole, founder of the Smart Investor out of Singapore. Now, David, great to have you on the show.
Salamat Tankan, how are you, Brian?
Now, David, before we get your insights, let's take a look and see how markets have performed this afternoon. Now, if we take a look at the KLSC, it's at 1,593.72. It's up 0.4%. Shanghai is at 3,267.44. It's up 0.48%. The ASX All Ordinaries is at 7,795.2. It's up 0.07%. The Nikkei is at 27,703. It's down 0.43%. The Hang Seng is at 21,805. It's down 0.87%. And rounding up the numbers, we've got the Kospi, which is at 2,736.09. It's down 0.71%. Now, David, what's your view on how markets have performed this morning?
Well, apart from Hong Kong, I would say the markets are about as flat as a roti paratha, Brian. I think people are just sitting on their hands at the moment because there are lots of data points out there for people to try and digest, and they're just trying to get some sense of what is happening in Asia and what is happening around the world. And I'm sure you want to address one of those big points, which is the inversion of the US bond yield. But apart from that, I think people are just waiting to see what is going to happen. If the futures indicate that the American market may open stronger today, then I think we'll get some follow-through buying over here in Asia, particularly if Europe has a strong start also.
Now, okay, David, I'm going to take your cue on that. And there are three key data points that we probably need to discuss. Now, the first thing is the Caixin Market Manufacturing Purchasing Managers Index that came in this morning at 48.1. Now, that's the lowest level since February 2020 and down from 50.2 last month. Now, the second data point is the Bank of Japan's quarterly Tankan Business Sentiment Survey for large manufacturers sentiment. Now, that came in at plus 14, a decline from the previous quarter's reading of plus 17. The third point, of course, David, as you mentioned, is the 2-year and 10-year Treasury yields, which have inverted for the first time since 2019 overnight. Now, what that means for our audience is actually this. The bond market rate for the 2-year note is now higher than the 10-year note yield. Now, what does that actually mean for everyone? Traditionally, that has been a signal that a recession could be on the horizon. David, what's your view on this?
I think whether we look at the Chinese Caixin index, anything below 50 would suggest a contraction, or whether we take a look at the Bank of Japan Tankan and have a look at that, and there are certainly concerns amongst the big manufacturers about their outlook for the future. But it is really that third one that you alluded to, Brian, the inversion of the yield curve. I mean, traditionally, you would expect the interest rates on long-term yields to be higher than those of the short-term yields. When you think about it realistically, if you're going to be lending money, which is what bonds really are, if you're going to be lending money to people over a 10-year period, you would expect the rate of interest to be higher simply because of all the uncertainties that can happen over a 10-year period. But when it inverts, it would suggest somehow that maybe the economy is going to contract and that the Federal Reserve may have to think about cutting interest rates in the future because of that contraction in the US economy. So it is a worrying time, I think, for investors. Apart from me, of course, I'm not worried at all.
Now, there's also stresses that you're seeing in earnings for companies as well. And we don't have to look too far and look at Hong Kong. Today, 33 companies were suspended from trading because they were not able to post their results on time. Now, what's your take on that?
Well, I think many of those companies will probably be property developers, and they're unable to produce their audited results. For what reason, I have no idea. Either the auditors can't do the audits, or whether those companies want to hold back a little before they actually release them. But because they are late in releasing those figures, the Hong Kong Exchange has no choice but to suspend them and say, until you actually produce those results for us, we're not going to allow those shares to be traded. I mean, many of these companies could produce their unaudited results if they wanted to. But they're reluctant to do that because they're afraid of what the market might make of those unaudited results. But it's not a good sign, particularly for those property developers. And I think the Chinese authorities, the Chinese government, the central bank in China itself will have to work overtime at the moment to try and sort of find some way of rescuing these companies, because I'm sure the picture is not that great, Brian.
So, David, the picture's not great globally. As investors, as individual investors, non-institutional investors, what should we be doing given the fact that we see a recession in the horizon?
Well, the thing is, you need to buy yourself into these recession-proof companies. And as I said rather flippantly earlier on, Brian, I'm not really that concerned because I've seen recessions come and go. And when the market freaks out over recessions, it's almost as though these people have never seen a recession before. But all that a recession is that the economy is going to slow down. And when it slows down, there are opportunities for investors. When you think about the kind of stocks that you want to buy, Brian, and I have to say that over in Malaysia, you have so many of these companies, these consumer-facing companies that will probably continue to generate cash, continue to pay dividends for their investors, and those are the ones that I'm looking at. And I'll just mention a few names for you, Brian. British American Tobacco, is that going to be affected by a recession? Probably not. Carlsberg, is that going to be affected by a recession? Probably not. What about Heineken? Probably not also. What about the milk companies like Dutch Lady? Probably not. You're still going to need milk for your cereal in the morning. What about Nestle? That's not going to be affected. So there are lots of companies, particularly in the Kuala Lumpur market, that I'm really attracted to at the moment, and they have generous cash flows, and they also are capable of paying their dividends. And guess what? They were still paying their dividends even during the pandemic. So that goes to show just how strong these companies are, Brian.
Now, David, as always, thank you very much for your sagely advice and your insights.
Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on Biztech's Asian Midday Market Watch, powered by our Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, our social media platforms, as well as our Rajhi Bank Malaysia's social media platforms. Please like and subscribe to our various platforms. Thank you very much for tuning in.